Three, two, one. We are live today in a stunning reversal that caught Wall Street off guard. The stock market plunges. It has its worst day of the year and its worst day since June of 2020. Is worse ahead? Where do things turn around? What happened with inflation that made the market go down so much? But why was there such a nasty reaction that caused stocks to literally plunge and to see the last months of gains literally evaporate? What caught people so off guard? We're going to talk about that today. We're going to look at the good, and there is always some good. We're going to look at the bad, and we're going to look at the ugly. A day like today, there's not much you could do beside survey the damage. So that's what we're going to do. But we're going to look at a couple of other things. We'll talk some strategy. We'll make sense of it. You'll go along your merry way. And believe me, if you practice good personal finance habits, invest for the long term, you'll realize that as tough as today was in the stock market, it's part of the process. Down markets are not separate from up markets. Down markets are part of up markets. That's my theory. I'm sticking to it. And I'd like it to actually become your theory because that's the way markets work. We're going to roll the introduction. We're going to have a really good show. Now, please, I'd love to hear from you. Ask a question in the comments about personal finance, whatever we're talking about today, the stock market, etc. Words of encouragement, words of wisdom in the comments are always appreciated as well. And hey, since you're here, give it a thumbs up, a heart, an applause reaction, whatever reaction is available to you, depending on which social media platform that you're watching on. It helps to spread the good word about the work we're doing here. It helps your other contacts see the show, attract some attention so that other people can see this and help, and maybe we could help them out too. So let's roll the intro. This is going to be a really good show because it was a really interesting day. Here we go. Hey there, I'm Mitch Goldberg. Thank you so much for joining me. This is my live stream. It's called Be the Boss of Your Money. What it's about is about you taking control of your money. Maybe I should just call this the Money Control Station or the Money Control Mission or something like that instead of Be the Boss of Your Money. But I'm kind of stuck with it. I've been using it for so long. I'm going to stick with it. But I really do mean it. I want you to be able to take control of your money because it's, money has a strange way of taking control of you instead of you taking control of your money. You know what I mean. We've all been there. So that's what the show is all about. A lot of what I do is not necessarily telling people what to do with their money as a financial advisor. With over 30 years of experience, I often tell people, in fact, more often than not, I tell people what not to do with their money. But let's talk about the stock market. Why the stunning reversal? We had 4 excellent, positive, strong up days in the market. We started to see trend changes in like the 50-day moving average. Stocks started looking good technically on the charts, but that was all erased today. And it was just in such a stunning reversal. And that's what's so crazy about this day. And I could use the word what's so crazy about this day because of the magnitude of the losses. When the TVs were on and the futures were up before the inflation report came out this morning at 8:30 a.m., futures were up like 200 points and it was looking like a good day. And everybody was very optimistic that we would get a subdued or lower than expected inflation figure. So if you don't know, the consumer price index figure, which is right now the most important economic statistics that we could follow, the main inflation gauge, it came in this morning. It was announced this morning at 8:30 a.m. Eastern. It was stronger than expected. Even with the dramatic fall in the price of oil and gasoline, inflation still went up. And the core CPI went up. What does that mean? You have the raw number, okay, of inflation that includes the price of gasoline, okay, the price of food. You have the core number, which excludes food, which excludes energy, gasoline, and that we would have expected to show a retreat as well. So everything came in a lot hotter than expected with regard to inflation. It means that the Fed pivot, hold on, it means that the Fed pivot, it's not happening so fast. This is why when the market hit its June lows, it bounced because investors expected inflation to come in subdued, less than investors expected, and the Fed could stop raising rates, maybe even start to cut rates. That went away after the last two employment reports, and then markets went down, and then they started to come up the last couple of days. Again, on expectations that inflation could come in a little subdued, a little cooler than expected. But you know what's happening? Every time investors get bulled up and expect something good to happen with inflation or employment figures, they get smashed down again. It's like a whack-a-mole. You pop your head out of the hole and someone smashes you over the head with a hammer. Investors are starting to get gun shy. And it's a tough situation because now that we're in a technically driven market, meaning level, we broke 4,000 on the S&P 500, 3,900. The low is below, the June low is a little below 3,700. As we expect to break these lows, as we expect markets to go lower, now no one wants to get in front of that steamroller. Well, why should I buy now? I'll just wait. So you have a shortage of you have a shortage of buyers and a plethora of sellers, a lot of sellers, and that is just really causing stocks not to just drop, but to gap down. There were a lot of stocks down 5% plus, including the heavyweights that typically move the market. So these are the things we're going to take a look at right now. So let's take a look first at the boards. Just going to position my screens a little better so that you'll be able to see what we're looking at. Okay. So let's take a look at all the numbers, and then we're going to show you how we're going to survey the damage first is what we're going to do. Okay. Pop myself up here. All right. So the Dow is down. You see that? Almost 1,300 points, down about 4%. NASDAQ down over 600, down over 5%. S&P down over 4%, down almost 180 points. Now, I've always said this. A 1% drop in any of the major averages gets my attention. A 2% drop definitely gets my attention. 2.5%, 3%, that's a pretty rough day. But when you see 4 and 5% drops in the major averages, you know this is newsworthy and it's a pretty bad day, even down enough to be memorable. Gold continues to go down. Oil backed off a little bit. 10-year treasury yield was up only a little bit. The VIX was up, not as much as I would have expected. The VIX up to 27. I would have expected it to even hit 30 today. But still, the fact that it's up in a down market is normal. The VIX does the opposite usually of what the stock market does. Now, if you recall yesterday, and this maybe is was a significant tell, and we didn't realize it. Yesterday, we were looking at the VIX. You and I were looking at it together, and the VIX was flat yesterday, even up a little bit while the stock market was up. The VIX should have been down a lot yesterday while the stock market was up yesterday, but it stayed flat. And it goes to show you that professional investors, smart money, was not betting one way or another on how inflation would come out. Now, a lot of people expected inflation to come in pretty tame, pretty cool. Coffee. There's iced coffee in this cup, by the way. It's good stuff. So, a lot of people expected inflation to come out more tame, and they were betting on it en masse. And the reason was they were so confident because oil has come down so much. Price of gasoline has come down so much. It didn't help. And just a lot of investors are caught on the wrong side of the trade. Now, when I say investors caught on the wrong side of the trade, this doesn't necessarily mean you and me. I know for me, for my clients, we're investing and we're not changing our stripes because the market is up big or down big in a day. My day today was pretty mundane. I really didn't do anything differently today than I did yesterday. The up market or down market doesn't mean anything. I have a process. I follow the process, and I surrender the results. That's how it works. You just keep on moving on. Clients have money coming in, clients have money going out. Some clients are taking their required minimum distributions now instead of waiting till December. Some clients want to open up a 529 savings plan. Some clients want to buy this, and sometimes I need to rebalance an account, give a client an update, return calls. It's really the mundane stuff. I'm good at the day-to-day stuff, and that's what makes it. I'm not here to be a superhero and swing the bat as hard as I can every time I step up to the plate. Man, oh man. Well, that's my philosophy. Okay. So let's take a look at bonds. In particular, the treasury market. Yields were up pretty much across the board, except for the 1 month. That was just an anomaly. But this is stunning. Okay. And we talked about this yesterday. At 2.5 and change, the 2-year, I was saying this thing could hit 4% pretty soon. Look at that. Well, look at that. Would you look at that? Well, would you look at that? I have a TikTok in my head. I don't know if you ever saw that TikTok. Would you look at that? Oh, would you look at that? Anyway, 3.75% on the 2-year yield. Holy cow. Short-term rates are really up there. Jeffrey Gundlach of the Double Line Bond Fund, who is considered, the king of the bond market, he came out today and said, buy bonds, buy long-term treasuries. That is about as contrarian of a call as you could possibly get right now. In any event, 3.74, the 10-year only 3.44. So still over 30 basis points, about 33 basis point spread of negativity. See this 3.4? This should be higher than 3.7 or 3.7. This should be lower than the 10-year. It's an inverted yield curve. It indicates expectations of a recession. We've already had 2 quarters of negative GDP. I called it. Look, I take credit when I'm wrong. I'll take credit when I'm right. Okay, that's what I'll do. And just to give you an idea of how bad things did, what really drove the market down. Okay, Apple, we just had an update the other day. Oh, just a quick shout out. Dan Buckley is out there. Thanks, Buck. I really appreciate you, man. We got a comment out here. LinkedIn user. I don't know why. It doesn't show your name, but I appreciate you asking. Why do you think that Bitcoin is held up over 20,000? Can I get back to you on that in a second? Because I'll go over crypto in a moment. Okay, I'll answer that now. Okay, let me put your question up here now. All right. So, why do you think that Bitcoin has held up over 20,000? I don't think Bitcoin has held up. Bitcoin, it was in the $60,000 range. It went down to about 18,000 recently, then to 24, then to 18, then to the low 20s. It's been going back and forth. I wouldn't exactly call it holding up. Now you could say, well, how come it hasn't gone down a lot? Well, how come it didn't go up a lot recently when the stock market went up in the last couple of weeks? I just don't think Bitcoin is necessarily holding up so great as it is. It's just been volatile like everything else. So let's take a look at Bitcoin. Let me just take a look. Give me a second. I don't have it up here. Now I do. Okay, so Bitcoin was down almost 10%. I mean, that's down more than, that's down about twice as much as the NASDAQ. So I don't know if it's really holding up so great. It's barely above 20,000. But I think the worst thing for Bitcoin, for crypto in general, is I've said this before, I love this expression. The worst thing for crypto, including Bitcoin, is a Federal Reserve that has gotten religion about fighting inflation. And the Fed's raising rates. One of the attractions of Bitcoin was that there's only a finite amount that can be mined. And as the Fed prints more and more dollars and treats the dollar like junk and just prints so much of it, it would make something like Bitcoin, which has a scarcity value because of the limited amount that can be produced, that could be mined, it would make that more valuable. But once the Fed gets religion about fighting inflation and raising rates, reining in money supply, that actually makes the dollar more valuable. And if you haven't noticed, you may have the dollar has been super strong against other global currencies, incredibly strong. It's been so strong that it's actually expected to hurt corporate earnings. So a very strong dollar. And I think ultimately a strong dollar is the worst thing for Bitcoin. And that's what's happening now. So I don't know if it's really a matter of that it held up 20. It's look where it's come from. Okay. But I appreciate the question, and I hope that if we disagree, it's respectful, and you and I, Mr. LinkedIn user or Mrs. LinkedIn user, are still friends. Okay. So let's keep going. Let's keep going. I'm going to show you another screen. This is like says so much of how bad things were. This is interesting. Oh yeah. Oh yeah. Oh yeah. Okay. Here we go. This is the top gainers in the S&P 500. Out of the 500 companies, 1, 2, 3, 4, 5 stocks. So 494 stocks in the S&P was down. One was flat, and only 5 were up. And the ones that were up today are barely up. So that just goes to show you how bad things are. And if you look at the worst performers, a good chunk of them in technology, but it wasn't only technology. Eastman Chemical, okay, so materials, NVIDIA Technology, Meta Technology, Lumen Technology, Western Technology, Advanced Micro Devices down almost 9%, technology, Caesars, gambling, okay, consumer discretion, Generac Holdings, industrial, Whirlpool down, industrial, NXP Semiconductor, technology, Capital One, financial, okay, that's the financials, obviously, Lennar Home Builder. So the downside was spread pretty much everywhere. Best performing sector of the day was only down 2.5%, was energy. Worst performance was, as you'd expect, tech and communications. Now you see this XLC. This is the communication. This drives me crazy. All right, XLC, the communication services select Spider. Okay, S&P depository receipt. By the way, did I tell you that? Did I tell you this little secret? You can't invest directly into an index fund, but you could invest in a security that tracks or mimics an index. Just make sure I had to get that in there. XLC is an ETF that tracks the consumer discretionary sector as defined by Standard and Poor's. And it's the communications name in it that throws people off because you think, well, what is it? AT&T and Verizon. But if that is what you think, you may be surprised to find that there's a lot of tech in it. So let me just tell you the top 10 holdings of XLC, the communications sector ETF, 18% of it is Meta Holdings. Do you know what Meta Holdings is? That's Facebook. Facebook changed its name to Meta. So almost 20% just in Facebook. You know how Facebook has done this year. It's been a disaster. Okay, 23% is in Alphabet. Alphabet used to be called Google. Okay, that was a really poor performer. And then only 4.75%, okay, is in AT&T, and 4.6% is in Verizon. So less than 10% of the communications sector, as per S&P, is in AT&T and Verizon. But people think they're getting a big slug of Verizon and AT&T when they buy it. But if you look at this, 46% is just in technology. So it's basically a tech fund. I don't even know why we have this fund, to tell you the truth. I just don't even know why we would have that. Okay, so that's my my beef on the XLC ETF. If you have any questions, hit me direct. Okay. What else we're looking at? I think that's pretty much it. Let's talk about what's good in the hood. Okay. Stocks like NVIDIA, Apple, Microsoft, Netflix, big heavyweight stocks in the S&P 500. These stocks got crushed. And when the really big companies, the big stocks get hit, that has a much bigger degree of impact on the S&P 500 than smaller companies taking a hit, going down. And you just can't fight that kind of hit. The big stocks like Apple, and Microsoft were down so much today that you really couldn't help but have a down market today. So let's talk about what's good. A couple of things you could do now. You could say, I'd like to own some of the best companies, or some of the companies that you think are best. Okay. It's subjective. And I have to point that out, that I can't just say what the best company is in a live stream. We'd have to talk about that one on one, because it's really about what's the best company to buy, the best investment to buy for you, not necessarily the best. There is no such thing as the best. There's what's best for every individual. That's why financial advisors don't like to get into recommending specific securities in a public forum. Okay. Um, just so you know, we have a responsibility that others don't. Now you know. If you didn't know, now you know. Okay. So I don't know. I do know. We have just stocks that are down substantially, and now maybe this is your chance to buy into them. Maybe it's a chance to buy a little bit of a great company that you think you've missed, and put a limit order in to buy a little bit more if the price drops another 3 or 4 or 5%, and put a limit order in to buy a little bit more if it drops another 3 or 4 or 5% after that, and another limit order, and another limit order. And as the market comes in, your buy orders start getting hit. That's one thing that you could do now. The other thing you could do is say, let's do some tax loss harvesting. Now, I'm not an accountant. I don't give tax advice. You need to speak with your own tax advisor. But what I do talk to my clients about is something called tax loss selling. And that's something we can definitely talk about. And that's when you have a stock like a tech stock that's down a lot. You sell the stock, you realize the loss. And what do you do with that money that you just raised from the sale of that losing stock? You could take that money and buy a different tech stock. Because presumably, if techs turn around, the tech stock you sold could go up, but the one you bought could also go up. And since stocks move with their sector, if one goes up, they probably all go up. So that's one thing you could do. And lastly, you could consider converting your IRA to a Roth IRA. Since the value of the IRA is down, if you convert it to a Roth IRA, which counts as a taxable distribution, taxable IRA distribution, you'd have less money taxed, because your IRA, no doubt, is a good deal smaller today. So that's another thing you can do. You don't have to just convert your entire IRA to a Roth IRA. You could do part of it now and part later, see how things go. There's all kinds of ways to turn a down market into your friend, as long as you're willing to wait for the next up market. And that's the key, because individual stocks don't always recover. But every down market, the major averages have always recovered and have always gone on to new highs. If that is your belief, then we definitely have something to talk about. Thanks so much for watching. It's been an interesting day. I see some other peeps out there. Melissa Robin, thank you so much for joining me. I greatly appreciate it. I think you're new in the show without watching the show, Melissa. So thank you very much for taking the time. I'm going to get going. I have to skedaddle. And let's hope for a much less interesting day for tomorrow. Have a good night.